All right, so why don't we go ahead and get started? So thank you for joining. I always look as if I'm in the tropics. Okay, well, I don't know what that means, Eric. Eric says that I look like I'm in the tropics. I'm in Sydney and it's raining a lot. But anyway, thank you, Eric. But throw me off now. So to get started, I'm Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. Today, we're going to talk about ETF model portfolios that we have and just ETFs and building portfolios of ETFs in general. Anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're in New Zealand, you can get a copy of our FAP on our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to reach out to a financial advisor if you want personal advice. And despite not being able to offer personal advice, would love questions. So send through any questions or comments about how I'm in the tropics, which is, yeah, a good comment, I guess. I just don't understand it. All right, so we're going to talk about ETFs and we're going to talk about building portfolios with ETFs. So first, we're going to do a little bit of foundational information about how you might want to build a portfolio. Oh, no. What did I do? Okay, first we're going to figure out how to use my computer. There we go. All right, and by the way, you can listen to our podcast. You can follow us on Instagram. You can come to our conference on Thursday, a week from today in Sydney, in Darling Harbour at the ICC. You can also watch that from your own home. So the whole thing will be streamed online, and anyone, whether you attend in person or you come to the conference watch it online, you'll get access to recordings from everything from the conference for 30 days. And if you'd like a ticket, send me an email and I can get you hooked up with a ticket. So we're going to go through this process fairly quickly, but before you want to build any sort of portfolio, whether it's an ETF portfolio or not, you of course need to go through the goal setting process. So it's something that we talk about a lot, that I talk about a lot, but any investor, it's really, really important to know what you're trying to accomplish before you actually jump into picking investments. And I think that in general, people get that idea backwards. And a lot of that is marketing. Of course, the way that the investment industry talks about investing, that it's very product focused. And it's very product focused, of course, because people are selling you products. But we want to step back and we want to start with you and make sure that those products are appropriate for you. I think that's another misnomer about investing, that everyone seems to think whether something's a good or bad investment, but really what we're looking at, is it a good or bad investment for you? So that's why we want to start with you. That's why I give all those personal advice warnings at the beginning of these things, because I don't know anything about you and I can't tell you if something's a good or bad investment. I can't tell you what to do without knowing all of the information about you. So start with your goals. So what we want to do, so we want to have defined investment goals so we know exactly what we're trying to achieve. And what we want, of course, for anyone who tuned in on Tuesday, we want us to get very specific about those goals. We want to know when you want to achieve your goal, how much money your goal will cost, so you know what the target is for your investment portfolio. We want to know how much you're going to be able to save until you get to your goal. And of course, we want to know how much you have now. And the reason we want all of that is because we want to use that to calculate a required rate of return. That's, of course, the return that's needed to get from where you are to where you want to be. And that's going to have a huge, huge influence on the types of investments that you select. And as we go through these model portfolios today, you will see that they are based on different levels of risk you need to take. But what reality that means is different levels of return over the long term that you need to achieve your goal. And that's when we get into this step right here. It's asset allocation. So with our model, ETF model portfolios, they have the same asset classes in them, but the allocation to them is different. Once again, based on those return objectives and how much risk you need to take on in order to achieve your goal. Once we've gone through that process, then it's time to actually go pick investments. And one of the things that I think is nice about our ETF model portfolios and nice in general is that there are a lot of ETFs, and this number is actually higher now. It's over 300. And these ETFs, of course, are in lots of different categories. So what we're trying to do is we're trying to cut through all these products. It's just proliferation of products that are out there. We need to cut through those, and we need to find the very specific products that fit our investment objectives and allow us to achieve your goals. And we want to do that through an IPS. Now, if you're using an ETF model portfolio, you don't necessarily have to go through the whole IPS process, but still, it's important to understand sort of the strategy that you're going to take. In this case, it would be using ETFs in order to achieve your goals. I've got an example of an IPS in here, but I'm going to go through too much detail on this. Once again, continuing on with that example. So what you want in your IPS, the IPS is your strategy and approach that you're going to take. For instance, I want to buy ETFs, or I want to use ETFs as the instrument that's going to help me achieve my goals. I want to take an active strategy with them, passive strategy with them, etc. All right. When we're looking at active and passive, and once we get into these ETF model portfolios, you'll see that they have both in there. But what we want to look at when we're trying to determine if we're going to use an active or passive ETF is we want to look at what the exposure that we're trying to get. So what is that asset class we're trying to get exposure to, and what strategy will actually work best? Now, I think many people out there think that you have to pick one, that you either have to be an active investor or a passive investor. That is not true. There's multiple ways that you can employ both types of investment approaches. So passive, of course, simply following and replicating an index, and active, somebody's out there or something is out there. And I mean computers, not like some higher being picking what ETFs go in, or picking what securities go into that ETF. ETFs are both active and passive. So another misnomer I think out there is that all ETFs are passive. But whether it's a computer, an algorithm, or an individual picking what securities go in there, that's an active strategy. All right, so how do you look at active versus passive? Well, there's a couple different definitions or there's a couple different factors that you want to look at. Number one, you want to look at efficiency. So market efficiency is something, and maybe you've heard the term efficient market hypothesis, but market efficiency refers to how much security prices reflect value. So if you are an adherent to the efficient market hypothesis, you would say that security prices always reflect their underlying value. And collectively, as investors, when new data and new information is available, investors collectively take that and appropriately reprice securities. Now, nobody really goes to that extreme, and nobody really thinks that that is true. On the other end of the spectrum is, if you completely disagree with the efficient market hypothesis, you would say that security prices probably never reflect their actual values, that they are being invested. Humans are making investment decisions. Humans are driven by non-rational reasons for investing, or non-rational forces like fear and greed that we famously hear about from Ben Graham, that people are driven by those emotions, and they are not, for the most part, making rational decisions. Now, in reality, the market probably is somewhere in between those two, and at times can be very efficient, and at times cannot be efficient. Meaning at times there's more rationality involved in the decisions, collectively, the decisions that investors are making. And then at other times, particularly when there's really high volatility, that the market can be less efficient. There can be a bigger gap between what something's worth and what it's trading for. And right now, for example, many people would argue, is a time where there's potentially a bigger gap. So when you get these market extremes, when you get fear driven by losses, which is what we've had this year, that you'll see bigger gaps exist between value and cost, what something's trading for. Conversely, you also see that at the top of the market, where there's a lot of sort of speculative mania, where people's decisions are being driven by greed. Once again, that's when you can see very overvalued markets, because These are not rational assessments of securities values. They are people trying to get rich as fast as possible. And that greed is driving a misalignment between value and what something is trading for. But what we can almost certainly agree with is that different markets and different asset classes have different levels of efficiency. And in general, what this means is the level of competition and the number of investors that are looking at a certain asset class means that that is probably more efficient, right? There are more investors looking at that. There are more professional investors looking at that who are supposed to, although it's not actually true in reality, they're supposed to be more rational than individuals. So let's use some examples around efficiency of different asset classes. So if we look at the most invested in index in the world is the S&P 500, which represents the 500 biggest shares in the US. So first of all, everybody probably has some sort of exposure to US equities somewhere in their portfolio. So it is still the largest stock market in the world. It is the largest economy in the world. And so the 500 biggest shares in the US are going to get a lot of scrutiny. A lot of people are going to be looking for mispricings. A lot of people are going to be investing and following the news on what's happening with these companies. A lot of people involved in it. So we take that and we compare it with something, and I don't know why I picked this, but if we compare it with the Malaysian stock index, well, a lot less people are paying attention to what's going on with the stock market in Malaysia. And a lot less people are doing that because it's a smaller market, which means there are some investors who can invest in Malaysia, right? Like it would be very difficult for me, for example, to invest in Malaysia because I can go out there and I can use any number of brokers in Australia to go buy US shares. It's more difficult for me to invest in Malaysia. A lot of institutional investors just won't invest in Malaysia because they have too much money, right? So they have too big of a portfolio, too big of a pool of money to manage to go invest in Malaysia because frankly, it would have no influence on their portfolio because the stock market's too small. And there are certainly institutional investors that are potentially not allowed to invest in certain countries. So these are extreme examples, but in a smaller market that less people are paying attention to and less people can actually invest in, there's more of an opportunity for securities to be mispriced versus what their value is, versus this big market that everyone's paying attention to. So that works in examples like that, right? And that's an extreme example, but it also works if we look at different parts of the market. Large cap stocks are the biggest companies in the world. So the S&P 500, or we look at the ASX, top 50 shares in the ASX, these are all big companies, they're all large cap stocks, meaning almost everybody can invest in them. Well, if we start getting into smaller companies, right, there is less efficiency. Same issue, right? If I am managing a ton of money, I can't go buy a small or micro cap share, very small companies, because I couldn't get a big enough position to influence my portfolio. So why would I do it? Plus, they are generally riskier in terms of volatility. They bounce around more. So some investors don't want to invest there and just want to ignore that. So you can see differences of efficiency when we start looking even within the same asset class, if we're looking at large companies versus small companies, for example. So how efficient a market is determines whether you want to take an active or passive strategy. Now, the trick, of course, is that nobody knows the actual level of efficiency because nobody knows the actual value of any security. And so that is the tricky part of this. But on the next slide, I'll show you one way of measuring this because you can generally measure it in the past. You just don't know what it is right now. Like in hindsight, of course, it's very obvious for us to sit there and say, hey, going into 2000, with the dot-com bubble, the market was very overvalued. Now we can say that because the market went down 50% in the case of the S&P 500 and 70% in the case of the NASDAQ during that period. So it's very easy for us to sit there and say, okay, the market was really overvalued. And the S&P 500 had, barely any return over that decade from 2000 through 2009. It's very easy for us to say that now. It's just very difficult in retrospect. It's very difficult for us to say that now, but we'll talk about how you can look at efficiency. The other thing that's important is how representative the index is to the available opportunities. So basically what that means is, does an index encompass the entire opportunity set in that asset class? So where we see this a lot is in bonds. So the bond market is very different than the stock market. The bond market, number one, is bigger than the stock market. Number two, you have all sorts of different bonds out there. So you have lots of companies that issue a couple bonds. You have governments who continually issue new bonds as they're funding their operations. You have, governments at the national level. You have state level bonds. You have town level bonds in some cases. You have bonds that are backed by all sorts of stuff. So when we look at a bond index is generally not very representative of the opportunity set. So once again, if that is the case, then that is a case where potentially active management could work better. Because if I'm a portfolio manager, I have thousands of different choices I can go out there for bonds, but an index that I'm tracking, that's only a small part of that. Liquidity is important. So liquidity refers to how regularly a security is traded. And why this is important? Well, if you are a passive investor, you want really liquid markets, because you want the ability to be able to enter and exit positions as an index may change really easily. Because if you can't do that really easily, then it's going to be a bit of a problem. Then you could have tracking error. Then you could have differences between the return of the index and the return of the security. So once again, we can use the same example that if we use the S&P 500, those most traded index in the world, these big companies in the US, it's very, very liquid market. So very, very easy for me to get in and get out of positions with small bid-ask spreads, and doesn't cost me as much. If we go look at very small companies, it could be very difficult for me to open up a position there because there just aren't that many shares being offered, which means that if I'm trying to buy and fill up a position in very, very small, if I'm an institutional investor, a professional investor, trying to build up that position, I'm going to move the market. And so, yeah, something important to consider. And then finally, fee hurdle. Right. So we hear about this all the time. And this is the, sort of John Bogle, who's the founder of Vanguard. This was sort of his mantra, right? That the fee levels of active management were so high comparatively to what they were to passive that there was no chance that somebody was going to consistently beat the market. Because not only did they have to beat the index, they also had to account for those fee differences. All right. And we'll get into the model portfolios after this. So when I talk about how we can measure this, it's very difficult for us to measure this, of course, right now, because there is no universally accepted version of value of each instrument. But we can go back and we can look at how active management has done in particular asset classes. Now, the concept behind this is that if there are large differences between price and value, that there are people out there, there are active professional managers as well as individual investors that will be able to outperform that index because of those differences. Then all I have to do is go find those securities that are mispriced. But if there are very small differences between price and value, then it's a lot harder for me as a professional manager to go out there and do that. So we do this report where we go back and we call it the active passive barometer. We go back and we do this twice a year. Morningstar does it twice a year. We go back and we look at, you'll see there are different periods of time, but we go back and see what percentage of active managers outperform their benchmarks. So these are the active managers that you're paying all this money to in fees in order to manage an active ETF or an active fund. And you can see we divide it between lower costs and higher costs. So don't do higher costs. That never works. But you can see in most cases, the active managers do not have very good success rates, especially over longer periods of time in beating the index. Right. So if we look at US large blends, that's a blend between value and growth. only 17.2% of the time is a manager able to outperform that index on a 10-year basis. So this is what you want to start thinking about when you're making decisions between active and passive managers. So if only 17% have outperformed the index, you got to be pretty good at picking a manager and then have them outperform. All right. So if you're going out there and buying an active ETF, you got to have a lot of faith in yourself that you're going to pick the person that outperforms 17.2% or the 17.2% of funds that outperform over that 10-year period. But if we get down into small caps, you can see some of these numbers are starting to go up. We go and we look at real estate, for example. If we look at emerging markets, something that's not very efficient, you start to see, and some of the bond markets as well, you start to see active managers more than 50% of the time beating that index. So this is what we would look at, and we look at saying, okay, these are opportunities in these particular asset classes because of the characteristics of it. These are opportunities where we might want to employ an active manager. Sorry, excuse me. That's very rude, but I was waiting to yawn for a little bit. All right, so let's go and look at our portfolios. So first thing I'd say before we get into the ETF portfolios, we have a number of different asset allocation models defined in Morningstar Investor. And I don't know whose account I'm logged into. I do not know who John is, but anyway, somebody must have, this is a communal computer that I am using. So we have these 5 different portfolios. Now, these portfolios are based on, of course, investment objectives. But think of these investment objectives as being driven by that return that you need in order to accomplish your goal. And that's what we want to focus on as investors. So let's look at aggressive. So if I need a high return, if I've calculated that required rate of return, I need a high return in order to achieve my goal. I need to take on more risk, right? That is the trade-off that we make as investors. We exchange risk for high long-term returns. And that risk is volatility. That risk is those asset classes in your portfolio that's made up of them bouncing around a lot in value. So what is happening this year in markets? We are, of course, down. We are in a situation where this volatility, what we're going through right now, is the price we pay for long-term high expected returns. So shares bounce around a lot in price. You can get very down years like we're having now, but over the long term, shares have one of the highest expected returns, and historically have had one of the highest expected returns. We go to the extreme and we contrast that with cash. Cash in the bank doesn't bounce around at all. If I have $100, I'm gonna have $100 tomorrow, the next day, every other day. It's guaranteed by the government at that level. I'm not gonna lose my $100. But as anyone who has a bank account knows, I'm gonna get a very small return for that. Right now, I'm getting a return that is way, way negative when I take inflation into account. But I'm not getting a lot of volatility. So those are the trade-offs. I'm not taking any risk, but I'm not getting very good returns and won't get very good returns over the long term. So depending upon the returns that you need is how you want to tilt your portfolio between growth and value. So in this case, our aggressive asset allocation, you can see 30% in Aussie equity, 45% international equity. These are growth assets. Listed property are growth assets. Infrastructure is growth asset. And then I have just 10% in defensive assets, fixed interest, international fixed interest, cash, right? So if I need a high return, this is the allocation I need in my portfolio. And if we go back and we go to very conservative, we can see, oh, all of a sudden it's flipped. A lot of my allocation right here, 85% of it is in defensive assets. So this portfolio would not bounce around a lot in value, but wouldn't earn me that high of a return. All right. Yes, I definitely made a mistake there, didn't I? Somebody just point that out. I was not sharing my screen. Sorry about that. Okay, let me show you again. Well, I can do it with the ETFs, so apologize. I screwed that up. Yes, lots of people said not seeing my screen. Sorry, I'm an idiot, which is not obvious. Lisa said, sorry to keep you awake. Yes, maybe I'm still jet lagged from being in the US. All right, I will go through that again because it's based on these ETF model portfolios. So the same thing I was talking to, those different asset allocations we have on our website, from aggressive to very conservative, the ETF model portfolios are built around those asset allocations. So once again, aggressive, you can see right here, same thing, that their majority of it is allocated to growth assets, international equity, Aussie equity, global infrastructure, listed property. Very little is in fixed interest. Once again, there's 10%, 8% in fixed interest, 2% in cash. So very little of that is in defensive assets. So this is a portfolio where we are getting very aggressive. So what you can see in each one of these ETF model portfolios, you can see a couple different things. You can read about the risk profile. Now, once again, we like to think of things in terms of risk capacity, how much risk you need to take on. Some people look at risk tolerance, and that's kind of what this thing is written for. But once again, it's calculating that required rate of return and understanding the return that you need to achieve your goals. And of course, you can go back and look at performance. Let's get into some of the securities in here. So for the most part, the securities, the ETFs that are in here are the same across all of these different portfolios. So we've got a growth, we're an aggressive. We've got growth, we can go all the way down to conservative. But for the most part, these securities are all the same. It's just the allocations to them are different. So we're going to go through some of these securities and talk about the different considerations that might come into play when you're building a portfolio. And anyone that does want this report, wants our ETF model portfolios, you can email me, mark.lamonica1@morningstar.com if you want this. It's also available for our Morningstar investor subscribers. Simply and we issue these quarterly. So this is the second quarter report. We have not done the third quarter one yet. It takes a couple of weeks to do it. Obviously, we just ticked over into the next quarter. So we publish this on Morningstar Investor. So that's available for any subscribers. But let's go through and look at the different ETFs that are in here, and we can answer a couple questions around why we might want to include them. Now, this portfolio that's been created has both active and passive ETFs in it. So something to keep in mind. So as we go through them, and I'm not going to spend all that much time on each one of these, but I'll just talk about the different exposures you're getting out of these. So what we're looking at here, that first ETF, that Vanguard Misky International Hedged ETF. So that is international equity. So you can see 18% weighting, biggest weighting. So that's 18% out of 41 total percent that we have in international equity. You can get to some of the other ones they are. Of course, the S&P ASX 200 ETF, once again, another passive ETF that is tracking the ASX 200. I guess one note about this Vanguard ETF, it is hedged. So what hedging means is currency risk has been removed from it. So if you are investing internationally, you are getting exposure to the underlying shares that you own, shares that are in this ETF, their performance. You're also getting exposure to currency changes. All right. So the day you buy into the ETF versus the day you sell out the ETF, all of the time you'll see fluctuations based on currency movement. So in this case, because this is a global ETF, it is the Aussie dollar versus all of the different countries that are represented in there and the currencies that are represented in there. Now, like any ETF that's international tracking index, the majority of that is the US. As an Aussie investor, you want the Aussie dollar to go down if you're investing overseas, because that adds to your returns. So this year, for example, where we've had big losses, especially in the US, we've had big losses because the Aussie dollar has done really poorly this year and gone down. you, of course, are insulated from some of those losses. So it's not going to make you positive, has not fallen, the Aussie dollar has not fallen that much, but because of those drops, you're actually insulated. So this portfolio is, I think, 50-50 hedged. So what that means is 50% of those international exposures are hedged. Now, you need to make your own decision on what works for you. A couple considerations around hedging is basically how you spend your money at the end of the day. So, right, in my case, like I happened to be in the US last week. In my case, right, if I'm going to spend a lot of money in the US, for example, if that's somewhere I go every year on leave, if I'm going to travel a lot, then the Aussie dollar falling, the benefits I get from investing overseas with a falling Aussie dollar, I of course lose when I go and try to buy a bagel in New York and it's $14 because the Aussie dollar is so weak. So just stuff to consider about how you're going to spend your money. It is very difficult to predict where currencies go. I will say, and I get this question a lot, you know, the Aussie dollar is really weak right now. So a lot of people are sitting there saying, hey, okay, over the long term, is it really going to get that much worse? Maybe this is an opportunity where I do want to invest in a hedged position because I think the Aussie dollar will go back up. So remember, years ago, you actually had parity between the US dollar and the Aussie dollar. But there's obviously currency movements, a lot of stuff happens with them. Anyone who has anything to do with the pound right now knows that. I will put my email address into the chat. So I did have that question. So there you go. That's my email address. So so Lisa's saying I left some cash in my US trading account and has mitigated the losses I saw in my US stocks. Yeah. So, you know, if you're sitting there on dollars right now, US dollars in Australia, things are looking pretty good. Just because of some of the drops that we've had. All right, so let's keep going down. And once again, I'm not going to go through every single one of these, but I will point out some of the different ETFs in here. So an actively managed ETF is Magellan Global. So it's gone through a number of name changes, but you can see that is an actively managed ETF. So that's, of course, where somebody is making a decision on the assets that go in there. Same thing with infrastructure, that Magellan Infrastructure, that is an active ETF as well. We also have some fundamental ETFs in here. So a fundamental ETF is something that is looking at certain criteria around a basket of shares, around a universe of shares. And based on those criteria, they are selecting some shares to go in and excluding some other shares. So this Van Eck Misky International Quality ETF is an example. So the Misky International is that wide international developed market index we're looking at. And the quality tilt on there means that they are deliberately picking securities that meet high quality standards. Now, people are probably asking, why would you invest ever in something that's not high quality? Well, because sometimes they significantly outperform. So when we talk about quality from an investment standpoint, we're looking at a couple different things. We're looking at companies that there is less variation in earnings. So their earnings bounce around less. We are typically looking at debt levels, and we're excluding companies that have a lot of debt. And those are just some of the screens, and they're different on every one of these ETFs, but we're looking at potentially return on assets as well, return on equity, trying to find sort of quality, good companies to invest in. So that's what that quality ETF is. Something else to consider, of course, is differences when you're investing internationally between emerging markets and developed markets. Now, emerging markets is an interesting term because emerging markets, there's no real way to graduate from an emerging market into a developed market. So they were kind of set at a certain time. The indexes were set, and they are what they are. And there are certainly countries in the quote unquote emerging market index, whether we're talking about South Korea, for example, Taiwan, that in any sense of the word, Israel as well, are developed, right? If we sit there and we look at per capita income, if we look at the economies in these countries, and then you have certainly countries that are more on the developing side. So yeah, take a look at those indexes, and the indexes are different. So this FTSE index, FTSE, that FTSE index is actually different than there's a Misky emerging market, and basically different countries are in different indexes. So something to think about. The other thing we want to think about in terms of allocating, why would you allocate to emerging markets? Well, you'd allocate to emerging markets without thinking about valuation levels. You allocate to emerging markets because you would probably get more volatility traditionally out of them, but hopefully would have you get rewarded for that volatility with higher long-term expected returns. So that's why you'd want to allocate to emerging markets. Same thing with small securities, so small cap shares. So you can see here is a domestic allocation, this iShares Small Ordinaries ETF. That's looking at small Australian shares. Why would you want to allocate to small Australian shares? Well, same reason. Any sort of small cap would have more volatility, it would bounce around more, but you'd hope over the long term there would be higher expected future returns. So if you're okay with volatility, that's an opportunity to invest in that. And then we've got, of course, some fixed income. Oh, here's an interesting one. VanEck Australian Equal Weighted ETF. So most indexes are market cap weighted, meaning that most indexes are the more money is allocated, or more of a percentage of that index is allocated to larger companies. So if we go and look at Australia, for example, Australia is dominated. It's dominated by BHP in terms of the index. BHP makes up a over 10% part of the Aussie index right now. So BHP, the big four banks, are making up a huge amount of that index. So even though you're buying, in this case, you're going to buy this ASX 200 ETF, and you're thinking, great, I'm buying 200 different companies. I'm really, really diversified. Well, not so fast, right? A lot of that allocation is to those banks, to BHP. Then conversely, if you have an equal weighted ETF, it is putting the same amount of allocation into every ETF or every company in there. So the 200 biggest company in Australia gets the same amount as the biggest company in Australia. And I don't know what the 200 biggest company is right now, but potentially none of us have ever heard of it, but it's getting the same percent allocation. It's getting 0.5%, right? It's 200 companies, 0.5%, just like BHP is getting 0.5%. Why would you invest in an equal weighted index? Well, really has to do with the views that you have, and these are very easy to look at, the views that you have of the sectors or the specific companies that are dominating local indexes. In the US, it's tech, right? So you start looking at Apple. So Apple's the biggest company in the world. Start looking at Apple. Apple's a large percentage of any US index. It's a large percentage of any international index. It really has to do with your viewpoints on those companies, or perhaps it also has to do with individual holdings you may have. You own BHP, you own a couple of the big four banks as individual shares, then you're buying an ETF. Perhaps you don't want to buy an ETF that then allocates most of its money into those same shares. Maybe that's an opportunity for an equal weighted ETF. So that's another good one to look at. So, oh, I cannot see your email address. Oh, I sent it to hosts and panelists. My fault. I will send it to everyone now. I am sorry, Jeff. Let me. Yep. All right. Hopefully now everyone can see my email address. So basically, each one of these ETF model portfolios, as I said, is investing in the same securities, but there are different allocations. So how can you use these as an investor? Well, obviously, one thing you could do is you could go out there and you could replicate this index. What I would say is replicate this model portfolio. What I would say is for most investors, there are probably way too many securities in here. So what this should be used as is a guide for different securities that we like best based on certain allocation, based on certain characteristics. So how you can interpret this is you can sit there and say, okay, we've got Vanguard Misky International ETF. That is a passive ETF. It is looking at global developed markets. And the fact that it's included in here means that our analysts believe that that is the best passive ETF to get access to those global markets. And you have to think about, okay, is this something that I want to invest in? By the way, Vanguard also has a unhedged version as well. If I think that I should invest more in small caps, if that's what I want to do, okay, what do we have here? Well, we can have the small cap ETF that we believe is the best way to get exposure to the Aussie market or the international market, depending upon what it is. So that's how I would use this. I personally would encourage most people not to go out there and buy every one of these ETFs, because of course there's trading costs associated with all of that. But use this as a guide and look at the different allocations that are in the different portfolios and use those as a guide to determine where you should actually invest. Okay, so, well, I will mention this. So Stuart says he's very disappointed with the changes to Morningstar. Is now, I cannot do a portfolio schedule to watch changes in the value of the portfolio. So I assume Stuart is referring to the fact that we launched a new website on Saturday. So that website is intended for people who are not Morningstar Investor subscribers. So it's free to everyone, where people can get some data from us, can get access to our editorial articles and a lot of the insights that we have at Morningstar. So for paid subscribers, our portfolio manager is now managed through ShareSite, which we've been talking about for a couple years now. So yes, we no longer do have a free portfolio option out there. We will roll out, hopefully later this year, watch lists that people can use. But yes, we do not have a portfolio manager anymore. So that is Stuart's question. All right, so if there aren't further questions, I will probably end this right now. But if anyone wants a copy of our June ETF model portfolio, send me an email, mark.lamonica1@morningstar.com. I will flick you that copy. Hopefully in the next week or so, we will come out with the new version, the Q3 version, where basically you'll just see different performances and probably not great performance after what happened in the market. But you can go look at any changes that occurred there, and that will be available for Morningstar Investor subscribers on the website. So anyway, thank you guys very much. I'll do one of these on Tuesday. We're taking next Thursday off because I'll be at the conference. Hope to see you guys there. If you would like a discounted ticket, just send me an email, that same email address. And I hope everyone has a good day. And if you're in Sydney, stay dry, which seems to be a daily occurrence saying that. Anyway, thank you guys very much for joining.